Today, we're going to be talking about the financial analysis of Dillard's. Dillard's is a department store that has roughly around 395 stores in the world, and they employ around 40,000 employees. Dillard's sells men and women's clothing, children's clothing, home decor, and cosmetics. Dillard's was founded by William Dillard II in 1938 in Nashville, Arkansas. The first store that was ever part of a shopping mall was in 1964. Dillard's has about 22% of their revenue comes from the sale of women's clothing, which made them become the number one top department store in 2014. Four competitors. They have Kohl's, Macy's, JCPenney's, and Nordstrom. These competitors all have different types of betas that will be later talked about in the presentation. Dillard has had a loss of sales. Three main ones are a decrease in income and an increase in online shopping with other department stores along with their own, an increase in advertising and promotion. Dillard has two main future goals. They want to remain competitive with other businesses, and they incorporate a lower price strategy, which is from a decline in their price product demand. They have salaries. That their salary stock option includes bonuses. You have the CEO who makes around $4 million a year, the president who also makes a little less, around $4 million a year, and Mike Dillard, who serves as a executive vice president, makes around $2 million a year. In the chain of command, we have William Dillard II, who is the chairman of the board and the CEO of the company. There are approximately 11 board members, which include James Freeman, Alex Dillard, Mike Dillard, James Freeman, and Drew Matheny. Alex Dillard is the president, and James Freeman serves as the senior vice president and the CFO. Mike Dillard and Drew Matheny also serve as executive VPs of regional merchandising.
The current ratio of a company has to deal with current assets and current liabilities. Dillard's current ratio has been consistently above the industry average, which is 1.7, last year being 2.2. A high current ratio means that Dillard's can pay back its current liabilities with current assets alone relatively quickly. The most desirable current ratio is between 1 and 3, and Dillard's achieves that with being 2.22. There are a couple ratios of Dillard's that need improvement, one of them being return on assets. Dillard's return on assets has been consistently below the industry average, which is 10.8%, its highest over the past few years being 10.69%, and last year just being 6.7%. Return on asset has to do with assets and net income. This low ratio can be due to a slowed down growth rate or a stopping growth rate altogether with the declining revenue. Another ratio that needs improvement is return on equity. Return on equity industry average has been 31.1%, and Dillard's highest over the past several years has been 22.42%, last year only being 14.12%. Return on equity has to deal with money that investors invest into the company. So a low return on equity would mean that the shareholders that invest in Dillard's aren't getting a good return on their money. The free cash flow of a company has to deal with how much leftover money a company has after all expenses have been accounted for. This extra cash at the end can be used to reinvest in the company, such as building new buildings, opening new department stores, or giving to its shareholders through dividends. Net profit margin has to deal with what percent of each dollar that a company earns is turned into profit. In 2012, it was about 7%, and it has been steadily declining for Dillard's, and last year it was just 4% for net profit margin.
Dillard's can measure its stock's risk in comparison with the overall market risk. This comparison is known as beta. Dillard's beta is 0.99, and the stock market beta is 1.00. So you can say that Dillard's has an average beta in comparison with the overall stock market. In comparison with its competitors, JCPenney's has a beta of -0.5, Macy's has a beta of 0.66, and Kohl's has a beta of 1.09. Typically, the higher the beta, the more risk that particular stock has. So in this instance, Kohl's has the most risk, and JCPenney's and Macy's would be considered the safer investment, and Dillard's falls in the middle, the average with the market or the industry. So the actual and required rates of return. The required rate of return is 6.46%, and a risk-free rate was used to calculate this measurement of 2.37%, a market rate of 6.5%, which led us to find the actual return of 2.62%. These calculations led us to the discovery that Dillard stock is actually overvalued. This just means that the expected return is less than the required return. Dillard's currently has 2 outstanding bonds, and outstanding bonds is a payment that allows Dillard's to continue its operations that they promised to pay back at a specific or later date. Dillard's currently has 2 outstanding bonds, both of which are semi-annual bonds that have maturity dates of 2018 and 2028. Both of these bonds have a par value of $100, and their current prices are $103 and $113. Neither one of these bonds are callable. Both of their bonds have BA ratings, and what a BA rating means is just that the bond is considered a junk bond. A junk bond isn't necessarily the best investment. It normally has a little more risk. So when looking at Dillard's outstanding bonds in comparison with one of its top competitors, Kohl's, a few things can be noted. Kohl's has 10 current outstanding bonds. All of these bonds have BAA ratings, which is a safer rating, and they have lower interest rates. So Kohl's bonds have interest rates of 3 to 5%, whereas Dillard's interest rates are all over 7%. But the biggest difference between the companies is that Kohl's bonds meet their required return and Dillard's does not. So that can be the argument that Kohl's might be the better investment over Dillard's.
Dillard's dividends have been, over the past few years, increasing by 2 cents consistently. However, with a declining free cash flow and declining net profit margin, it is likely that growth will decrease to around 1 cent annually. Here's the historical free cash flow, and the best fitting line is shown here, and it is clear decline is shown. Dillard's, with 2% increase in dividends for the past several years, that is about 7%. But as I mentioned, with a declining free cash flow and declining net profit margin, we estimate a 4% increase for dividends over the next several years, which is about 1 cent. The reason for this is Dillard's has closed several of its department stores and increased shopping through online through sites such as Amazon. There are several different models to find the intrinsic value of a company. Intrinsic value is the true value of the company and the true risk that investors take on when investing in that company compared to what the market says the value of a stock for a company is. One of those models is the Gordon model. The Gordon model uses dividends to estimate what the intrinsic value of a stock is. There are 3 rules for the Gordon model. 1, the company must pay dividends. In this case, Dillard's does. 2, the firm must have a constant growth rate in the future. In this case, that's 4%. And 3, the required return must be greater than the growth rate for the dividends. In this case, our required rate of return is 6.46% and our growth rate is 4%. Using the Gordon model and using these numbers, we found that next year's dividend is likely to, with 4% growth rate, is likely to be 29.12 cents. And with that number, the intrinsic value is about $11.84. This suggests that the market overvalues Dillard's stock, as the intrinsic value is about 1/4 of what the stock is trading at in the market today. Another model to find intrinsic value is the corporate valuation model. This model uses free cash flow. This model is not the most accurate or best model to use for finding stock for Dillard's, just because the free cash flow has been inconsistent and not been growing or declining at a constant rate over the past several years. But with over the past 2 years with a decline, we expected a minus 2.5% growth. Using the minus 2.5% growth, we found that next year's free cash flow for Dillard's is about to be $277.59 million. And with that number, we found, using the corporate valuation model, that the intrinsic value is $8.16. This once again suggests that Dillard's stock is greatly overvalued in the market, and this shows an even bigger difference from the Gordon model than to the market that it's trading at today.
So a P/E ratio just shows a stock price in comparison with the earnings per share. The industry average for department stores as a whole is 16.9, and this was just calculated by taking Macy's and Kohl's and just averaging them together to come up with the industry average. Dillard's is 12.52. So since Dillard's is below, the industry is considered riskier than some of its competitors.
The weighted average cost of capital is the average rate of return that a company wants to compensate to its investors. Typically, the higher the weighted average cost of capital, the higher rate of return you're going to get, which, if it's higher, it means the more risky your business is going to be. To find the weighted average cost of capital, you have three components: preferred stock, debt, and equity. Our debt was 14.95%, while our equity was 85.05%. We didn't have any preferred stock, so in conclusion, our weighted average cost of capital in 2017 was 6.19%.
Dillard's has a few strengths that are worth noting. First, the company does a decent job utilizing its domestic market, and basically what this means is that Dillard's has about 100 stores within the United States that are located all across the country that offer products to men, women, and children, and then there's also cosmetics, accessories, and home decor. So they just have a large varying audience. Also, Dillard's has a growth rate of 4%, and the market or the industry growth rate is 5%. So despite declining trends in the department industry, Dillard's is still tracking with the industry as far as the growth rate. And one other strength that's worth mentioning is that Dillard's pays a consistent dividend. As previously mentioned, it has a 2-cent increase annually, and despite Dillard's free cash flow declining, it has still paid a consistent dividend to its investors. Some of Dillard's weaknesses, one weakness that's a little bit out of Dillard's control but still affects Dillard's overall, is the decline in the shopping industry for department stores. Another decrease is the growth of online shopping and online markets. Dillard's has yet to be able to figure out the best way to be able to compete with online retailers such as Amazon, and Dillard's has had trouble trying to figure out how to compete with the convenience and the accessibility that Amazon provides. And then one other weakness is the current large gap between Dillard's intrinsic value and its stock price. So after looking at some strengths and weaknesses that Dillard's has, we can assess future financial predictions. As previously mentioned, Dillard's has a debt ratio of 14.95%. So this shows that while Dillard's is still able to meet its debt payments, it's not utilizing debt to its advantage. And since it has such a low debt percentage in comparison to its competitors, it can be assumed that Dillard's is not expanding or investing its money. Another factor that contributes to some financial predictions would be the decline in free cash flow. In 2014, free cash flow was over $400 million, and in this past year, it was just $280 million. That's a large gap within a 3-year period. And the fact that declining free cash flow isn't necessarily a bad thing if Dillard's is using the money to invest or to expand, but Dillard's is not currently expanding into new markets, and they're not adding on to the markets they're currently in. Another factor that can be brought into financial predictions is that Dillard's current outstanding bonds have junk ratings. This means that they're a little riskier than some of their competitors, such as Kohl's or Penny's or Macy's. And also the fact that there's such a limited number of outstanding bonds and it's a low price in comparison to its competitors is questionable as to, is Dillard's really using its bonds as a source of capital? And then, as I just mentioned, the decrease of the gap between intrinsic value and stock price is very concerning. If this market, if the industry as a whole is going to continue to decline as projected, then eventually intrinsic value will continue to reduce. Having such a low intrinsic value currently is not a good sign to investors. Investors don't invest in stocks with such a low intrinsic value unless they're anticipated to increase. So if the intrinsic value continues to decrease, it's ultimately going to drive the stock price down. So what's next for Dillard's? What can Dillard's do to have a more promising financial future? I narrowed it down into 3 major factors that Dillard's needs to evaluate and reassess. First, they need to reevaluate its market. If you look at Dillard's current target market, it's usually ages 14 or ages 40 years or older. So what's next for Dillard's? I kind of narrowed it down into 3 categories that Dillard's needs to do in order to improve its financial outlook for the future. First is that Dillard's must reevaluate its market. If you look at Dillard's current target market, they are targeting 40-year-olds or older. They're relying on people who have shopped at department stores their entire life to continue their sales and to stabilize their market. So Dillard's needs to come up with strategies to reach a younger generation, a generation that's not used to and not reliant on shopping at department stores. Also, Dillard's needs to come up with a competitive online strategy in order to be able to compete like brands like Amazon and to reassume that their market will shop online. Younger generations shop online. The future of shopping is online. So this will not only help their sales in the future, but it will help in reaching that younger target market. And then also, Dillard's must look for opportunities to increase its free cash flow, whether that's through sources such as outstanding bonds or if it's through debt. Dillard's must figure out a way to stop its continual decline of free cash flow in order to maintain and stabilize the company and shoot it on a path to growth within the future.